Thank you everyone for coming to Become a Millionaire session 11. Thank you for sticking with me all year, and I hope you're getting something out of this. So my sister Mary heard last month that I was running out of poems. So last month I did the Beatitudes. So Mary wrote me a poem. She called it the BAM poem. So we will begin today's session with the BAM poem. If you want to get rich, you will need a plan. Budget your expenses as fast as you can. Learn new strategies. Don't be a fool. Pay yourself first. It's the golden rule. Augment your income. Pay off credit card debt. Get a part-time job. Now you're all set. Cut your expenses. Save the pennies not spent. That's just a small start. Save up to 25%. Expand your wealth. Let your money grow. Invest in companies that you already know. Buy yourself a home. Save on income tax. Get a good mortgage. Live free and relax. Make capital gain. Harvest capital loss. Use 401k and IRA to be your money's boss. Be patient and aggressive. Follow your own guide. Be safe. And God bless. Have a jolly good ride. So thank you very much, Mary, for writing that poem. Mary's my sister. So we got Peter. Peter missed the poem. Okay, so the agenda for this month, we're going to start as usual reviewing last session. And then I'm going to announce the Become a Millionaire podcast. So we'll talk about that in a minute. Then I'm going to talk about the Etf strategy I've been talking about since session 2. And I did something called back testing on it. So we'll talk more about that in a little bit. And then we spend some time talking about Expand Wealth 25%, which is the individual stocks module 4. And we'll talk about that in a bit. And then, as usual, I'll go over the Become a Millionaire account update. We had a really good month, even though September was horrible. October really rebounded very nicely. And then we'll review this session and talk about the rest of the year, which is really just December. So you guys have done a good job hanging in there. So last month, we talked about cut expense 15%, 20%, and 25%. And this revolved around, as you augment your income, getting a little bit of feedback. As you augment your income, it becomes easier to cut expense and save 15, 20, 25%. So as you augment your income, from 10 to 15 to 20, 25%, it becomes pretty straightforward to increase the amount you can save. And then last month, we talked about Expand Wealth 25%, individual stocks module 3. We talked about Motley Fools. We talked about Louis Navellier and how these analysts recommend stocks based on their expectation that key metrics will improve over the next few years. And those improving metrics will drive the price of stock up, or at least that's the assumption. And then we talked about ARK Invest, which is Kathy Wood's company, how they make investments based on companies' ability to increase shareholder value based on innovation. So she was very focused on the new technologies, AI, electric cars. So she was looking at a number of future trends and how that would drive stock market value. And then we went over did a quick overview of some of the ARK investment big ideas for 2021. So that was the last session. And for last week's session, you were supposed to go view BAM session 8 and BAM session 9 on the YouTube site. And that actually covered individual stocks 1 and 2. Last month was 3, and this month is 4. And then as part of your homework, you were supposed to try to skim through the ARK Big Ideas 2021 report. So hopefully you did that, and it'll give you some good ideas for how to focus your investments. So announcing the Become a Millionaire podcast. So I decided to take my program, my Become a Millionaire program, and put it in podcast format. And I think this complements the YouTube site very well. You obviously should view the video or view it live first, but after you do that, the podcast is really a wonderful way to reinforce some of these concepts while you're doing other things. So, you can listen while you're driving. I know some of my members like to work in their garden. I know Peter likes working in the garden. Mary likes working in the garden. Well, you can listen to the podcast while you work in the garden. I know Zhang likes to work out while you listen, so you can listen to podcasts while you work out. And you can listen while you're doing many, many other things. So what I've done is I've hosted my podcast on Podbean. It's one of the more popular ones. And basically, this is the site. And by the way, they don't call them sessions in podcasts. They call them episodes. So I have episode 1 through 10 uploaded to the Podbean site. And the way to get access to it is you either download the Podbean app and search for Philip B. Lee, or you can just go to any browser and put in philipblee.podbean.com, and you will get to this website, and you can listen to 1 through 10 at your convenience. And if you do go there, make sure you are subscribed to my site. I only have 1 subscriber now, which is myself, so I feel a little lonely. So you can do that. Or if you have Spotify already, I was able to post my podcast on Spotify. So if you go to Spotify, you go into the search bar, you put Philip B. Lee podcast, my sessions will come up, or my episodes will come up. So take a look at it. I've tested episode 1 and episode 2, and it works. Even though I can't see the slides, it works quite fine. So especially if you've seen the slides once, it's a great way to reinforce the information through the podcast. So, and subscribe to my Spotify account as well. Thank you. So the next section talks about the ETF strategy I've been talking about since session 2. And Stephanie, my son Chris, Diane, we were on vacation in August. And while we were on vacation, I was just telling my son Chris a little bit about this course and how I was teaching people how to purchase ETFs. And he asked me, "Hey, Daddy, did you back test it?" I said, "Did I what? Did you back test it?" Well, I didn't really know what back test was. So Christopher helped me put together a program that allowed me to back test the ETF strategy. So that's what we're going to talk about now. So first of all, what does it mean to back test a strategy? So to back test a strategy means to test it out based on historical data. So whenever you find, or when you discover a new strategy for investing in the stock market or building wealth, it's always a good idea to backtest that strategy if possible. And in this particular situation, it's actually quite easy to do the backtest. So my ETF strategy is based on using an ETF screener that I showed you all, I think that was session 4, had identified the top ETFs based on highest 10-year returns. And really, this is the foundation of investing baby steps, expand wealth 5%. So this is what we've been talking about all year. And this month, we're going to show you how it performs in the back test. So if you recall, my strategy was to have you look at the top 88 or top 44 or top 30 ETFs based on 10-year return and pick the ones you like. So for simplification, I decided that I would just pick the top 10 because obviously I don't know what you guys pick, but if I just pick the top 10 in the list, that would be representative of what you guys would end up doing if you select a subset of that. And then for simplification, I did not include time diversification. So I assume you buy all 10 ETFs on the first day of the trading year. So if I did time diversification, it would provide a level of safety, but that can both reduce or raise your potential gains. So just for simplification, I didn't include that. So here we put the top 10 10-year return ETF strategy to the back test. So here we go. So how do I do this? So this is the scenario. So to perform a back test, I make believe that I travel back in time to January of 2015. So I make believe it's January 2015, and basically I run that same screener that I told you guys about and find the top ETFs based on 10-year returns. So this is basically from 2005 to 2015. So those are the 10 years that I evaluated. And that's the same algorithm I used to give you the top 88 ETF list. But in this case, I only took the top 10. And my assumption was that I invested 10% of my money in each of the top 10 ETFs. And then I fast forward to January of 2017, which is 2 years later, to see what kind of return I got based on what I bought in January of 2015. So that's a 2-year return annualized. And then I looked at 2018, which would give me a 3-year return annualized. And then I would compare the 2-year return annualized and 3-year return annualized from my ETFs with the S&P 500, which in this case is IVV. That's the ETF that follows the S&P 500. So after I did that for 2015, I did the exact same thing for 2016, 17, 18, and 19. So I could not do 20 and 21 because, obviously 2 years have not elapsed yet. So I'll do the 2-year for 2020 in 2022. So here's the results of the back test. So basically, if I went back to 2005 and ran that screener, here are the top 10 ETFs I would have found: IBB, QQQ, IGV, VHT. Some of these look familiar because some of them are still on the top list. As you can see, IBB did 15% over that 10-year period. QQQ did 10%, all the way down to SLYG that did 9%. So on average, that was 10%. So this is the results in 2017. So this was the 2-year look. And you see, IBB did not do very well. They lost 6% per year for 2 years. But QQ did okay, et cetera. So if you looked at the average, it did 10% based on the 10-year return. And then the next 2 years did 3.7. And then the next 3 years did 9.5% per year for 3 years. Now, if I compare it to IBV, which is S&P 500, that averaged 5.5% for the 10 years. It did 4.7 in the 2-year return and did 9.4. So I think in terms of 2015, I would say that my returns, which is 3.7, 9.5, is very comparable to what the IBV was. So I would say, it does an okay job. Doing the same thing in 2016, you can see IBB still number 1. Now XBI is number 2, but it goes from 15% down to 8.7%. But if you look at the average, it goes from 10%, 10.3% to 12.6%, which I think is very good. And then over 3 years, it's 10.4%. To compare that to IBV, they did 15%, so we did 3% worse. But over 3 years, we did 2.8% better than S&P 500. So I consider this, at least for the 3-year period, superior to the S&P 500. So this, I think, this particular year supports the strategy in my back test. Looking at 2017, again, XBI is number 1, all the way down. QTech is number 10, average is 12.4. Over 2 years is 10.7%. Over 3 years, 16%. And that compares very favorably to the IVV, which was only 5% and 12%. So I did 5% better in the 2-year return, did 3% better in the 3-year return. So I consider this superior to the S&P 500. And then if I look at 2018, again, these are the top 10 ETFs, averages 15.8%. And then the 2 years after that did 18.8%, which is very respectable. And over 3 years, it does 19.1%. So you compare that to IVV, which is the S&P 500, we actually did 9.1% better in the 2-year time frame and did 8.1% better in the 3-year time frame. So I consider this far superior to S&P 500. So this again supports the strategy. And the last year I was able to do was 2019. So it turns out that because the 3 years is not done yet, 3 years won't be done until January of 2022. I actually did 2.7 years instead of 3 years, but it's close enough for what we're trying to do. So if you look at the top 10 ETFs for 2019, averages 19.2. The 2-year return's like 36.8, which is incredible. The 2.7-year return is 28%. And again, it compares very favorably to IVV. So we did 15% better in the 2-year period, and we did 7% better in the 3-year period. So again, far superior to S&P 500. So if you look over the 5 years that I was able to do the back test, you can see that the average 10-year return was 13.5%, but the 2 years after that, it did 16.5%, and the 3 years after that did 16.7%. So it's fair to say that it's roughly 16% over the 2 to 3 year period. You look at IVV, it's really 11% and 12%. So as you can see, we actually did a little bit better than the S&P 500 with this particular strategy. So just looking at the graph, you compare the 2 year period, which is the blue versus the gray. So you can see that the gray was actually better than the blue, but then when you get out to 2017 and beyond, the blue is much better than the gray. And then for the 3 year, it's the orange over the yellow. As you can see, the orange is always higher than the yellow. So for the 3 year return, the ETF strategy is actually quite a bit better than the S&P 500. So the summary is that this particular strategy is supposed to return 5%, and it's actually returning 16.5%. So I could say that quite nice. The average return over 10 years that we were testing was 13.5%, and then the 2 or 3 years afterwards, we'd be getting 3% more. So that's very nice. S&P 500 averaged 12%. So we actually exceeded S&P by 4%. And the back test actually supports the ETF strategy very well. But the data set's still kind of small. It's only 5 years. So you really need to look at like 10 to 15 years of back tests to really bolster the confidence we have in the strategy. But so far, it looks quite good. So I've back tested our ETF strategy, and it seems to work quite well. So moving on to the next topic, it's Expand Wealth 25% Individual Stocks, Module 4. So this is the fourth of 4 modules for Expand Wealth 25%. So just by way of review, we started off with investing baby steps, which was 5%, and we did this back in February. And I think in April, we talked about buying on a dip to improve your returns, and that was get you 10%. And then we talked about financial advisors. We talked about asset allocation, risk return, and we also talked about 401ks and IRAs as a way to improve your return, and that got you 15%. And then starting with 20%, we started with the individual stocks. So we, module 1, we introduced individual stocks. Module 2, we talked about TV stations like CNBC, Fox Business. We talked about websites, newspapers, and subscription newsletters as a way to improve your knowledge around individual stocks. Then last month, we talked about analyzing stocks and making investments. And we talked about the Big Ideas Report. And this month, we're going to talk about Module 4, which is future topics, which so what are future topics? These are topics that will become more important as you learn more about the stock market. So these topics are probably not as relevant today because you're just starting out, but they'll be more relevant in the future. So my goal is actually very simple. It's really give you an overview of these topics. And then when the time is right, when you've become more experienced, you can then get into these topics a little bit more. So I'm just going to try to give you a basic understanding and just allow you to be better prepared for the future. And my goal really is to present these, I think, pretty complicated topics in a simple language. So here we go. So here are the 7, what I call future topics or advanced topics. So we're going to start with margin account, selling short, a trading platform, the bid price, ask price, and last price, advanced order types, trading volume, and stock options. So those are the 7 topics that I will introduce you to. So what is a margin account? It's really just a brokerage account that allows you to borrow money for the purpose of purchasing securities. Securities being either stocks or ETFs or some other type of security. Now, to get a margin account, you have to apply for it. So, every brokerage firm has a slightly different rules, but they don't give you a margin account. Right up front, you have to qualify and you have to answer a bunch of questions and you have to apply. And if you qualify, then you'll get a margin account. So it's important to know that they're willing to loan you money because it's collateralized by the securities in your account. So basically, they're lending you money, but if things go bad, they'll take over your securities in order to pay off the loan. So it's something you have to be very careful about. Now, when you do borrow money, they do charge you interest on the money you borrow. The interest rate's anywhere from like 5 to 6%. So it's not insignificant. But if you're making 10, 15, 20% on your money, then it's okay to pay 4 or 5% margin. Now, margin accounts introduce more risk, but also potentially more reward. So you just have to be careful. Now, 2 of the topics this month is selling short and trading options. So in order to do both those things, you need a margin account. So it's important that I explain what a margin account is. And when you're comfortable, probably in a year, 2 years, you should apply for a margin account because that will give you additional things you can do that you cannot do in the regular brokerage account. So that's a margin account. Next topic is selling short. So what is selling short? What does it mean? What does selling short mean? What does long mean? What does short mean? So these are terms that's used in the stock market. So having a long position means you own the security. So anything you own, if you own stocks, then you are long on stocks. And when you're long, it means you expect the stock price to go up in the future. So that's why it's called long. So you expect it to go up, and that's why you're long. So you're also bullish on this stock. That's what it means. So if you look at this bull here, you see it's going up. Bear is the opposite. You're expecting it to go down. So bear is a short position is generally the sale of a stock you do not own. So just let that sink in for a second. So you don't own the stock, but you're going to sell it. It implies that you expect the stock price to go down in the future. So you're bearish on the stock. So that's called being a bear. And the reason you do this is because if you can, let's say, sell the stock for $10, and then if it goes down to $5, 6 months later, you can sell it for $5. You can buy for $5. So you would make $5 a share by selling short. So you can also be bullish on the stock market, and that means you expect the stock market to go up in the future. So I'm a bull. I always expect stock market to go up. But there are plenty of people on Wall Street who are bearish on the stock market. These are the people who are always predicting that the market will crash, but it means that they expect the market to go down in the future. So that's the difference between bulls and bears. So bulls expect the market to go up, bears expect to go down. If you're long, it means you expect to go up. If you're short, it means you expect it to go down. So that's a little primer on what it means to be long and short on the stock market. So here's a nice little video about selling short. So I'm going to play this for you.
Short selling is a concept that can be confusing to a lot of investors. So if you feel a little uncertain as we go through this description, hang tight because we're going to do a case example that I think will make it much more clear. Short selling is basically opening a position by selling it first, assuming that in the future, you're going to be able to buy it back for a cheaper price. Now, how do you do that? Well, when we sell to open and buy to close, you're basically borrowing the stock from somebody else. And in reality, you're borrowing it from your broker, basically. So you sell to open by borrowing the stock, and you don't need to worry about that. It's just an order type. Sell to open is the order type for selling short on a particular stock or ETF. Now, buying to close is just unwinding that position, or basically buying the stock or the ETF back later, hopefully at a cheaper price, so you get to keep the difference and then pay that back to your broker. Now, margin and interest is going to be required and incurred in a short trade. And what I mean by that is that you have to have a margin account in order to engage in short selling. If you don't know what that is, spend some time talking to your broker, find out whether or not you're qualified to use margin and whether it's something that you're interested in. And assuming that you are qualified for margin, short selling does incur some interest charges because remember, you're borrowing stock from your broker, so they're going to charge you for that.
Okay, hopefully that makes sense. I did some explanation of the previous slide to make that make more sense. Hopefully that was good. I like that explanation. Short selling is not an easy thing to explain. Now, I'm going to talk about something that's very relevant around short selling. So I'm going to talk about Gamestop. Hopefully you've all heard about it. So GME is the symbol for Gamestop. And it became the poster child for meme stocks in 2021. So I'll give you a little background. So since 2019, many hedge funds felt that GME was going to go bankrupt. They felt GameStop was going to go bankrupt. So they sold short, let's say short on GME. So remember, that means they sell GME when they don't own it. And they did that because they felt that video games were increasingly going to be sold online and downloaded. And so they felt that GameStop revenues would plummet in the future. So when GME was priced around $8, $9, they sold GME for $8, even though they did not own it. And they were expecting GME to go down to $2 or $3. And then they would buy it at that point and make $6 a share. So that was the whole point of selling short on GameStop. Now, in January 2021, which is, I guess 10 months ago, a subreddit group called Wall Street Bets took an interest in GME. So this subreddit group has 11 million members. That's a lot of members. They were very angry that the hedge funds were making money by selling GME short because many of these, millennials or the younger people, they have very fond memories of going to GameStop and buying video games when they were kids. So this is the subreddit site. So it's Reddit and it's called Wall Street Bets, and you can see there's 11 million people. So it's a pretty powerful group. So together, these 11 million as a group all decided to purchase GME at the exact same time. So this was in January of 2011. The power of 11 million traders descending on a single stock drives the price of GME through the roof. The stock goes from $8 as high as $483. Mostly it fluctuated between $150 to $350, which is still a lot more than $8. Today, it's about $173 a share. Hedge funds who had sold GME short at $8 had to cover. They had to buy GME, buy GameStop, somewhere between $150 to $350 to cover their short positions that they originally sold for $8, resulting in a massive loss. So if they sold 10 million shares, they would have ended up losing $2 to $3 billion. So that's the order of magnitude that we're talking about. So here's the chart for GameStop. So you can see that there was hovering around the $6, $7, $8 time frame, and then see. So this is like around January, February, maybe February. the price of GameStop just goes up over $400, I described. And then it came back down, but then it went back up. So this is really the impact of the subreddit forum or the subreddit group that Wall Street bets. So here's an article that says Melvin Capital, it's one of the hedge funds that bet against GameStop, lost more than 50% in January. So that's pretty amazing. So here they say that the shares of GameStop finished 400% higher in just a week, bringing total gain in the year to 1,625%. So that's in 1 year. So here's the punchline. So Citadel and 0.72 that has an interest in Melvin Capital. These companies had to give $3 billion more to Melvin Capital so that they could shore up their finances. And ultimately, Melvin Capital ended up with $8 billion, down from $12.5 billion. So they lost $4.5 billion selling GameStop short. So that's a long story, but yes, you can make money selling short, especially if you have strong conviction that a stock is overpriced. But you have to be very careful. I think Melvin Capital's analysis was correct. I think long-term, GameStop probably will go out of business. The same way that Netflix drove Blockbuster out of business, I think GameStop, the same thing will happen. However, if enough investors, either retail or institutional, decide to prop up a stock and drive the price up, they can. So bottom line, you can make money selling short, but you have to be extremely cautious. So I thought that was a very relevant story for 2021, where GameStop really hurt a bunch of hedge funds. So let's move on to the next topic, which is trading platforms. So what is a trading platform? So this is actually a picture of the trading platform, and we'll cover it a little more. So Active Trader Pro is actually Fidelity's dynamic trading platform that provides you with a customizable tool that helps you trade, which is buy and sell stocks and options, helps you track the market. So how's your stocks doing? See the latest financial news, monitor your portfolio, and more. So it's really a program that makes it much easier for you to manage the buying and selling stocks and tracking your stocks. So it's also, it's a product that's very customizable, so you can make it look the way you want it to look. And this actually is Active Trader Pro, and there's actually 3 screens that I had customized together. So this is really just a window on stocks itself. So this is the ETF that I've talked about all course. And on this particular day, I guess, I think it was in October. Oh yeah, the October 6th or 7th, this was when I took this picture. Tells you what the last trade of stock was, which was $452.72. And it tells you what the bid price is and the ask price, which we'll cover a little more later. What the volume is, that's 232,859 shares. It tells you the price it opened at, the range for the day, what it closed at yesterday, and what the 52-week high and 52-week lows are, and what the average volume over the last 10 days is. So this is called the ticker symbol. So this is the SOX ticker symbol. This is also SOX, as you can see, but this is what's called a candlestick chart. So again, it's very customizable. So what I did was I arranged this in 5-minute periods. So each of these bars, and we call them candlesticks, are 5-minute periods. So when a candlestick, each one of these, is green, it means that in that 5 minutes, the price of stock went up. If it's red, it means the price of stock went down. So in this particular case, it went up, it went down, it went up, it went down, it went down, it went up, 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 up. So if you're a technical trader, you look for patterns like this because it tells you that there's some momentum in the price of stock going up. So when you get more sophisticated, you find these charts will help you understand the best time to buy. Clearly, if it's going down, you don't want to buy because you want to wait till it hits the bottom. But first it flips, generally you want it to flip and then you want to confirm and then you would buy here and you would enjoy a little bit more improvement in the price. And then these are the volumes for each 5 minutes. So you can see that this is a relatively high volume 5 minutes. So that means there's a lot of conviction in that particular increase. These are actually smaller. So, even though it did what it did, there was not as many buyers and sellers. And then it gets to be a little bit more. Anyway, so this shows you a pictorial version of the volume that's being traded. That's called the Candlestick Chart. And this is a very detailed trading chart, and I'll explain this in a minute. So up here is where you decide, what security you want to do, the action, which is buy or sell. This is the order type that we'll talk about later. It can be a market order, a limit order. And then there's actually 3 separate windows here that I will talk you through. I'll start with the right. So what this is, this basically says that at 10:24, someone bought and someone sold. One share of ETF traded for $452.72, and that's the current price. 1 second before that, someone bought 20 shares at $452.74, and that's what green means. It means it went up. White means it's neutral, and red means it went down. So basically, this is from 58 seconds down to 44. So this represents 14 seconds of trades. And when you get more sophisticated, you can see how the market is going based on how the trades are going up or down, and it gives you a better feel for the direction the stock market is going in. So it tells you everything over. Actually, you can go much further. You can see a minute, you can see 5 minutes. So it just shows you everything there. Then you have what's called a bid price. So if you're trying to buy the stock, you're trying to bid for it, and you try to bid. You try to bid the highest price so that you will be able to buy, a share. So this person is bidding to buy 100 shares of stocks for $452.71. So you can see that's below the current price. So they're trying to buy it a little bit below the current price. But then there's another person who wants to buy 50 at even a penny lower. So if you look at this, you see that there are a lot of people that are trying to buy it for, 3, 4, 5 cents below the current market price. And that's how you can try to understand how strong the stock market is. If this drops quickly, it means that as people buy and sell, these go away, and then it gets moved up. On the other side, if you're trying to sell a stock, you're trying to sell it for as much money as you can. So even though the price is 72 cents, this guy's trying to sell for 79 cents, and someone's trying to sell for 80 cents, all the way up to 88 cents. So you can see it's a 9-cent spread between this ask and this ask. And on the bid side, there's also a 9-cent spread between this ask and this ask. So this just gives you a lot more information to understand what's going on with the particular stock ETF. And every stock has charts like this that helps you, do a better job trading. And that's what it comes down to. These platforms give you a lot more information than you normally get and allows you to be a better trader. So normally you get a chart like this, and this really gives you very summary information. So it tells you the previous close, the open. It tells you the lowest bid price and the highest ask price. So that's what that shows you. So let's move on to the next topic, which is types of orders. And this is more of an overview. So what we have talked about up to now is to buy ETFs at market. And when you place a market order, it basically executes at the lowest price possible. If you're trying to buy, it executes at the lowest price possible based on all the people that are asking. Or you can do a limit order. Limit order only execute at the limit price. So if you're trying to buy it for a little bit less than what the current price is, you would put in a limit price and it won't execute unless you get to that point. And then a couple more complicated ones. One is called stop limit order, which is really the equivalent of two orders combined. So you have to give it a stop price and a limit price. So when the stop price is reached, then it puts in a limit order. So this is a way for you to control what you pay for a particular stock. And the other one is called a stop loss order. That's also two orders combined. So you only provide a stop price. So when you hit the stop price, it puts in a market order. So it tries to sell as soon as possible as you hit a stop price. So these are four types of advanced orders that will give you as a trader more ability to control the price you buy an ETF or stock at. And if you're selling, it controls the price that you sell it as well. So it gives you a lot more control of what's going on. So delving into market orders. So market orders are transactions that are meant to execute as quickly as possible at the current market price. So if you just want to buy something, then you put it in the market. A market sell order will sell the stock at the highest bid price. So you'll be, remember I showed you all people bidding? Well, if you sell at market, you'll get the highest bid price. If you do a market buy order, you'll buy the stock at the lowest ask price. So, and the difference between those two is called the spread, okay? Use a market order to buy stock when the spread is low, so it's a very small spread, and if you know you want to own the stock at the current market price. That's when you use a market order to buy. Use a market order to sell when the spread is low, and if you want to sell the stock at close to the current market price. So remember, this is important when the spread is low. If the spread is wide, let's say it's 50 cents or $1, well, you want to start using limit orders because you don't want to overpay for the particular stock. So for market orders, the price of security is secondary to how fast you can complete the execution. So execution is more important than market order. For limit order, so here's the example for limit orders. So if you're trying to buy, let's say you want to buy stocks for $4.65. We see the prices at $4.65.79, but you want to buy for 79 cents less. So then you would put in a limit order to buy stocks for $4.65. So you could actually purchase stocks for less money doing it this way, assuming it's falling. If it doesn't fall to that point, then there will be no transaction. And if you're selling, you obviously want more money. So this would be a limit order to sell stocks for $4.70. And it will only execute when the price of stock gets to $4.70 or more. So again, limit orders is a way to control what you either buy a stock at or sell a stock at. Trading volume. Trading volume is the total number of shares of a security that we traded during a given period of time. So remember I showed you the candlesticks, we were doing 5-minute periods. That could be an hour period, it could be a day, but it shows you how the volume is changing. And this is called technical indicator, and it represents the activity of a security or a market. So investors use trading volume to confirm the existence or continuation of a trend. Remember when I showed you the candlestick, how when there was higher volume, I said that's more confirmation than if it's low volume. So basically, they're saying the trading volume legitimizes a securities price action. So if it's low volume, then it's not as confirmed a stock price. But if it's high volume, that means that that's a pretty firm price, okay? Okay, the last topic is stock options. And this is a very complicated topic. So I'm going to try to keep it at a higher level. So as an investor, you have many choices how you want to invest in the stock market. So traditionally, and what I've taught up to now, and what I think you should do for a while, is you should just buy a stock, wait till it goes up to a certain amount, and then sell it for a profit. That's what I've been teaching, and that's what most people do. However, stock options gives you and me as investors an alternative way to invest. And I'll describe that a little bit. So you don't buy the stock with stock options. You buy the right to buy a stock at a future time at a certain price by a certain date. Okay, so let me say that again. You don't buy the stock. You buy the right to buy the stock at a future time. So here's an example. If I buy a stock option, which is the right to purchase stocks for $4.50 anytime before January 21st, 2022, that would cost me $35.40. So that's an example of buying a stock option. So you have to give it a strike price, which is the $4.50. You get the premium, which is the $35.40, and you get an expiration date, which is January 21st, 2022, which is roughly 3 months. So taking a step back, so what is stock option? Stock option gives an investor the right, but not the obligation, to buy or sell a stock at agreed upon strike price by a certain date. And there's two types of options. There's a put option, which is like a short, so you're betting the stock will fall. A call option, which is a bet that stock will rise. So I'm going to only explain call options just to keep it simple. So here's my example. So I buy a call option for stocks for $4.50 before January 21st, 2022, and I paid $35.40. So what's the downside of buying a stock option? The first downside is I'm actually potentially paying the $4.50 when I exercise my option plus what I pay up front. So I'm actually paying $485.40 for a stock that's only priced at $472.30. That's $13.10 more than if I just bought the stock. Okay, so I'm sure you're asking, why would I do that? So, and then the second downside is the option will expire on January 21st, 2022, making my call option worthless if I do not exercise. So these are two bad things about buying a stock option. There's some good things. So the first good thing is that for $35.40, I'm controlling a $472 stock for 3 months. The second good thing is if the stock goes down, the most I can lose is $35.40. That's the most I can lose. But if you own the stock and it went to zero, you could actually lose $472 stock. So it's just another option, and a lot of people use options to get leverage. So let me give you an example. So if stocks goes up to 500, then I would make $50 a share. But remember, I bought this for $35.40, so net I would have made $14.60, which is not bad. To make $14.60 on a $35 investment is almost a 40% return. So that's good. However, if the stock falls below $4.50, then I lose my entire $35.40 because so I wouldn't exercise it. So it would expire and I would lose $35.40. So it turns out that you cannot buy one option. So the minimum lot size for options is 100 shares. So when you buy one lot, you're actually doing 100. So let me just take this example one step further. So if you purchase one option, which is 100 shares, at the strike price $4.50, that's $35.40 per share. So to buy this lot, it would cost me actually $3,540. So we talked about the $13 premium. So if stocks goes up to $500 in this case, I would have made $5,000 because remember it was $4.50 times 100, and it would be $5,000 after spending $35.40. So that's the same $14,460 profit on the $35.40 But if stocks never exceeds 450, I would lose the entire 3540. So that just gives you an example of stock options. So this is a picture of what it looks like. So the strike price is here, and the cost of the option is here. So this is the break even. So if it goes up, you can make unlimited profit, and your maximum loss is at the cost of the option. So that's just a nice little pictorial on what the option looks like. So the conclusion is that stock options provide leverage, allow you to control more stock for less money. So my example, you could control like your $47,200 worth of stock for a mere $3,450. So you're really putting a lot less money to work. It limits your potential loss to $3,450 instead of $47,200, but it's very complicated. You know, you have to worry about what the strike price is, what the expiration date is, and what the current bid and ask price are. So while I'm introducing the topic, it's not something you should do, you know, until you get more comfortable with the stock market. So those are the future topics I want to introduce you to: your margin accounts, which is borrowing money, selling short with my Gamestop example, the trading platform. We talked about bid price, ask price, and last price. Talked about advanced order types, trading volumes, and stock options. So if we look at the original ACE chart, you can see that we've completed 25% for all three strategies: augment income, cut expenses, and expand wealth. So update on BAM account. So I did this, let me see, November 1st, which was yesterday at 4 p.m. So this was yesterday's close. And you can see that SOX is up about 20%. XSD, which is another semiconductor ETF, is up 19%. IGV is up 16%. VGT is 16%. QQQ is 15%. PSI is up 13%. IHI is 11%. XNTK is up 3%. And PTH is down 0.35%. And PSI is down 1%. So not bad. You know, 1, 2, 3, 4, 5, 6, 7, 8 winners, 2 losers. So it's 80-20, not too bad. I'm up $339. I invested $3,000, and now I'm up to $339, which is about 11%. That's just the chart that I've been showing you every month. So basically, you can see that last month we were down as low as 3.87% is the absolute return. Annualized be 5.88. Well, this month, a month later, we're up to 11%, and then annualized about 15%. And it's just a little bit below the NASDAQ and quite a bit below the S&P 500. But remember, this was probably the 10% strategy. I'm getting 15%. So I'm pretty pleased with this kind of return, you know, given where we are. This is all-time high. This is based on February 2nd is when I first invested. Yeah, so that's already said that. So let's review this session. Basically, I announced the BAM podcast. I hope you guys go on and listen to an episode or two. I explained to you how I back-tested the ETF strategy, and it back-tests very well. And then we talked about Expand Wealth 25%, which is these advanced topics for the future. I want to introduce you to it, but they're very advanced, so I wouldn't worry too much about it. But when the time comes, you'll have some idea what these things are. So for homework, I want you to go to my podcast, either on Podbean or Spotify, and subscribe to it and listen to episode 1. I think it'd be a nice review. And then in preparation for next month, I want you to review your Become a Millionaire project plan and update it for 2022. So that's very important. I like to do things in full year increments. And then look at your long-term career plan and update that also for 2022. So if you do that, then you'll be ready for session 12. So just looking at a full year's curriculum, we just completed session 11. And next month, my plan is to put it all together. So I'm going to help you put together your plan for 2022 so that you'll be successful going forward. And it will bring all the ideas together in a way that's very accessible, and it'll make it easy. And you'll be all set for a great 2022. So I think that's it. So thank you so much for coming, everyone. It was an honor to have you all here. And if you can unmute, maybe we can have a little chit chat. Hey, Peter.
Hey.
Hey. What do you think? You missed the rehearsal.
Yeah. This is a pretty this is pretty involved on equities trading, and
it's futures. It's futures, yeah.
It's interesting, but I'm not sure a lot of people could keep the attention span for this is a pretty deep drill down on the technicalities of the marketplace. I mean, but if it's very useful. It might pique people's interest in trying to learn a little bit more about how actually stock market works and investing in equities and related instruments work. I'm just not sure if like a lot of the audience could really pay attention to that long to this pretty deep.
No, I know. So the reason I did this was because I know that the course is over. So these are future topics. I know I won't be around in the future to help them. So I just wanted them to have some understanding, really a high level understanding of these advanced topics. I don't want anyone to do any of this. This is way too advanced. But there'll come a point in time when they're, coming along and they say, I want to know a little bit more about selling short, or they'll have like an introduction.
Pique the interest. Yeah, I think that will
pick in later.
It will pique the people's interest. Maybe Edmund he knows everything, but everybody else, I think we have a problem following it.
I called this future topics and advanced topics. These are not present day topics, but it's the end of my course. So if I don't cover it, then it'll never be covered. So anyway, thank you for that feedback. It's a
lot of work though. You did a lot of good work though. It's a lot of
like every other month, I had to learn some of this stuff in order to put it together.
Yeah, I was gonna say
it's me to learn it better.
Yeah.
Actually, I mean, being out in Vegas is a little bit like stock options.
Yeah, I know. You know where that ends you. Hey, can you send me the link to the YouTube channel?
Of course.
I lost it somewhere. I want to catch up on a couple of weeks.
I will send it to you. No problem. No problem. I have about 600 views now. So I mean, that's not a lot in the grand scheme of things. I mean, Ed Sheeran gets like 600 views in about a second. So 600 in a year. So, but that's okay.
Wow, you compare yourself to Ed Sheeran. That's good, Phil. That's good.
I compare myself to Little Dragon, it'd be a little different.
I think Ed Sheeran should compare himself to you.
Ed Sheeran should take my course. He could invest some of that money he made.
He should.
Yeah, you remember Victoria? She started this class, but she started taking night classes for her master's. So I
know, that's what she said. She's going to go to chemistry instead of listen to me.
Yeah, but I talked to her. She said, well, she said she's afraid that the market is going to crash, and she doesn't want to get too much involved in it now. So I said, whatever makes you comfortable.
The market will crash. It always crashes. That's all. I mean, remember there's like in the course of 90 years, there's like 26 times it went down significantly. It will crash. You can expect that. It's just that the recoveries always outdo the crashes. But when it's crashing, it doesn't feel good. It doesn't feel good. When it's crashing, it feels like a root canal. So I'm kind of used to it. I've gotten kind of used to it. And I have confidence it'll come back, but even I mean, I remember during COVID, March of 2020, during COVID, I was down like 25% in like 1 month. It was ridiculous. All the business shut down, but it came back. So it did come back, right? So I mean, that's why I talk about over 90 years. It averages 7% a year for 90 years. And there's some years it goes down 25%. Some years it goes up 30%. And I mean, that's the long-term trend. Now, could that stop? Yeah, that could stop. I mean, as I told you early on, there is risk in investing. I mean, this is not like a free lunch. This is not like putting money in the bank and getting 0.01% that you don't lose money, but you don't make money, right? So in order to make money, you have to take some risk. So there is some risk. But I think that the smart money says that it will come back. The Warren Buffetts, the Peter Lynch's, all the smart people invest in it because they know that eventually it'll come back. But
and don't forget Ming Lee. I think he thinks the market will come back too.
For those who don't know, it's a private joke.
Lots of private jokes here.
Yeah.
Hey, Mary, I see you unmuted. What do you think?
You really did a lot of work.
Doesn't everyone like Mary's poem? That was a great poem.
Peter missed it.
Yeah, it was.
It was a good poem. Peter, you missed it. You have to go look in the video.
I will.
Poem this month.
Who's the author?
Mary's the author.
Wow, I missed a Mary's poem. You should have said that in your invite. I would have like.
Mary hadn't written it then.
Yes, Mary. Thank you for the poem.
Is it in English, Mary? Is it in English?
Yes, in English.
Okay.
The interesting thing about it is the picture that I gave you, Philip, has my name in Chinese in the background.
Let me show people that.
Check it out.
Yeah, show me.
Some artist wrote it for me when I was, I'm a teacher, right? And we had a visiting artist, and he would write his name. That's my Chinese name.
Mary's Chinese name.
Your one.
This is how it starts, Peter. It's if you want to get rich, you really have a plan. Budget your expenses as fast as you can. It's very good.
It's very good.
Yeah.
Well, it's based on.
When did you write this, Mary? When did you write this?
When?
Yeah, when? Recently or like a while ago?
No, just when he said he needs a poem. Remember
wow,
he a poem?
You mean like on real time? That's impressive.
No, he said he was running out of poem. Remember last week?
We had to do the Beatitudes last month.
Wow.
Last month he said
that's impressive.
So one day I woke up, I said, maybe I'll try to write him one. So I pulled up all this information. I went to the YouTube. I pulled up all the information, and I think I proofread it 3 times, and I said,
no wonder it's so relevant to what Phil's doing. It seems like
it's all information.
Exactly. It's a wow.
So I told him, I said, I've got the skeleton. Skeleton. I said, it's your stuff. See if you can fit it. So he said, okay, type it to me. So as I was typing, I finished writing it. Then I proofread it once, I proofread it twice, and I proofread it about 3 times, right?
Yeah.
Then it was complete. But it was like that the beats were not thought there, so Philip kind of like straightened it up.
Yeah, because when I read it, I realized that the meter and the rhythm, it sounds like something that he would. Something that he had written before, so it's a it's a family poem. It's a family
something like that, yeah. But it's all this information. I just took its information and put it.
Yeah, exactly. It's a synopsis of his teaching.
Right.
Elise, what did you think?
Really good.
Yeah.
Do you like the content, Lisa? And was it too heavy? Too heavy this month?
No.
No? Oh, good.
No, it's a lot. So
it's a lot.
You have to go over it again, but I love a classroom setting. If I could be a professional student and get paid for it, I would be the happiest person in the world. So I love listening to that, especially when it's you know, the way you present it. It keeps your attention. So,
Sure.
yeah, it's a lot of information, but it's helpful information and information I'm sure a lot of people wish they had before they started investing. They didn't know enough, so.
Hey, Lynn, I see you.
Hi, can you hear me?
Yes, what'd you
I
think?
can
Lynn?
hear you.
Oh,
Yeah.
I really enjoyed it. Yeah, thank you. And it did pique my interest. You threw out a few little carrots, the nuggets of the possibilities for the future. So that did pique my interest. And the GameStop stuff is just riveting. It's such a fascinating story.
I'm telling you, Dolphin Capital lost $4 billion.
Yeah.
That's a lot of money.
What's interesting is the Squid Game.
Yeah, what?
I finished the Squid Game first.
Everyone see Squid Games?
I
Netflix?
finished it.
I've seen it. Yeah, it's
I haven't
good.
watched it yet. You recommend it?
Oh,
Yeah.
yeah. Yeah, you
It's
should
fun.
watch it.
Only if you like that genre. It's only if you like that genre.
Watch it. It's riveting. It's riveting.
Yeah,
It's-
I'll check it out.
Hunger Games meets what? Meets somebody. Hunger Games meets.
It's like it's kind of gory though. If you don't like blood, you might not want to see it. But it's interesting.
I can deal. I could do Game of Thrones, Red Wedding. I could do this.
Oh,
Yeah,
I-
if
oh,
you like
okay,
Game of
okay.
Thrones,
You do the red weather, you can handle it.
yeah, this is more cartoon violence. This is more cartoon violence than the Game of Thrones. Yeah.
Yeah, and I heard a little bit about it, so I'm intrigued.
Squid Games is
I'll
currently
check it
the most widely watched Netflix show ever in the history of Netflix.
Wow.
Yeah,
Yeah, I have to
Yeah,
watch.
I like the games. I like the games. I like all the children's games.
That's because you're a
I like the
teacher,
kiddie
Mary.
games.
Yeah.
Did you watch Squid Games?
I haven't. You guys have too much time on your hand.
That is true.
That's what happens when you're retired.
That is true.
Oh, Edmund, you're not retired yet?
Oh, it's a burden. Peter knows.
That's because you keep going to Vegas every Thanksgiving.
That's right. He's trying to get rich the fast way. He was trying to go to Vegas for a week.
It is like, give me a couple of 100,000 and we'll double it.
Okay.
No, none of that talk. None of that. Stephanie, what do you think, Stephanie?
Yeah, it's very good. I told you at your rehearsal.
You did. Stephanie taught me it's called a subreddit. It's called subreddit. I didn't know it was called subreddit, but thank you, Stephanie.
What is subreddit? What is
I
that?
think nobody knows.
You know that group that went and hurt bought GameStop no matter
Yeah.
what?
Oh, they call themselves subreddit?
Well, Reddit is a social media site, and there's a forum called Wall Street Bets, and that's called subreddit.
Oh, I see. Stephanie, were you involved in that? Were you part of that group?
No,
It's okay if you are.
No.
You could claim credit for
I
hurting
didn't,
those hedge funds.
I didn't
Go back to
understand
that
what was
website,
happening at the
though.
time.
Go back to that website, to see that no icon.
Right.
It helps because we didn't understand it at all.
Let me bring. Hey, Ishan, how you doing?
Hi, Philip.
Thank you for coming. I think Ishan's first, but he's seen a bunch of my videos.
Oh, good. This is.
Can you hear me?
Yes, I can.
Yes, we can hear you. We can hear you, Ishan.
Yeah. Hi, Philip. This is my first session, but I've seen. Right now, I'm on session 3.
Oh, good. Yeah. No, this is a little advanced for session 3, but that's okay. Hopefully, you could follow it.
Yeah, it was pretty good. I don't think I would like to do trading, but I'm so happy I learned all these topics today. All these terms I see floating around everywhere. But yeah, at least I got to know the terms. Also, I'm a data scientist and I do a lot of back testing in my daily job. So when you were explaining that, it was
Scientist are you? Do you use R? Use R or use
I use Python mostly.
use Python?
Yeah.
Oh, maybe you can teach some Python.
Phil tried to do something in Python. He actually did a pretty decent job with it.
I love Python. You know, when I was in school, they didn't have Python. We had stupid language like Fortran and C. And then Python is so good. Honest to God, if I had Python when I was when I used to code 30 years ago, I would have been so much more productive. It's a much better language. Yeah, I'm a dinosaur. So what kind of, is this your work, your data sciences at work? Ishan?
So
Are you a scientist at work?
yes, I work on time series data, and it's mostly networking data. So, and we forecast in the future for better capacity planning of networking bandwidth. So, and that's where we get back testing. We do back testing on past data. So, but I haven't done it on stocks until now. So it was nice to learn about that. So,
Oh, you're gonna be in so much trouble. Accumulating the data and
Hey, there's one person that's called DNPDKMV. Who are you? Can you come talk to us? DNPDK. Hi. What's your name? Oh, you got unmute.
Yeah.
Hi. I can't hear you too well.
yeah, there's a lot of echo.
Yeah, that's okay. Well, thank you for DNPDKMV50D84. Thank you for coming. I appreciate it. Oh, this is Chris. Chris who?
Christopher.
That's
Chris
my
for your
son. Is that Chris?
That's your son.
Well, why is my son DNP?
Because he's
Oh, that's different.
Wow, that's mysterious.
Really, Chris? Oh, it is Chris. Wow.
he needs better. He needs a better internet.
I think I'm on my phone. I'm at the gym.
Oh, he's at the gym.
Wow. Wow, he's working out and listening to you.
Chris is a rock climber. Chris rock climbs.
Oh, is he? Wow, that's impressive. Rock climbing.
It's a bit impressive. When I see
The podcast.
those rocks, it's amazing.
Yeah.
Phil, he could use the podcast.
Oh yeah, he can use the podcast.
He could use the podcast.
Yeah.
Everyone needs to go subscribe to my podcast. I'm very lonely. I only have one subscriber.
Already started signing up. Just got to come up with a name.
What kind of name do you need? Oh, you can get on Spotify, Lynn.
Because I had one that's kind of like Chris's. It just, I already followed you
It's
on
on
Spotify.
Spotify.
Yeah, I'm on Spotify.
Yeah, I followed
what
it.
should I look up?
Philip B. Lee. Philip B. Lee podcast, and you'll get become a millionaire. Oh,
Emma
that's
could market this for you. Emma could market this.
I can.
He could get a following in a matter of minutes.
Wow.
so, guys, I can't believe this is session 11. So next month is my last session, at least for this year. And
What
I
are we gonna
haven't
talk about next month?
exactly what I'm going to do next year yet. Oh, next month, I'm going to, for December, because now you know everything. So you've gone through 11 sessions. So I'm going to take all that information and I'll put it together to help you plan 2022 and how you take all the information and make it something that will make 2022 a success towards becoming a millionaire. So I'm going to focus on 2022 because that's the way I do most things. Is I say, a year is a good time because every year you come up with your New Year's resolution. So you should set some goals for you. So I'm going to take this information and put it into a format of the next 12 months and how you're going to use this information, how you're going to put together a plan and make some progress towards becoming a millionaire. So it's really about taking all this information and putting it into action over the next 12 months and making some progress. So that's what next month will be about. And then I'm still trying to figure out what to do for 2022, if anything. I'm definitely not going to redo this. So I did this once. It's on
Yeah, I can't find it, Phil.
YouTube. It's fine. But I might do something. Yeah, I haven't figured out yet. So I'll talk more about it next month. But it's been a long year. My goodness, this has been a lot of work, but it's a lot of fun. It's been so good to have all you people in the session. It's been terrific.
Yeah, I can't find it, Phil. It comes, there's a bunch of Philip Lee.
Oh,
Only one Philip B. Lee.
B.
Yeah.
BC has a Bartholomew.
Yeah, like Bartholomew,
Oh, wow.
Yeah.
Nobody knows my middle name. Wow. So you really can't find Edmund?
Oh, I
I'm on
found you.
Spotify right now.
Yeah. So
I got you on Spotify, and I'm following you on the Podbean.
Oh, you got me on both already?
Yeah. I think I have to change my name. I've got a name that's kind of like Chris, MX, blah, 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 blah.
Edmund, look at the screen. So I did this myself. If you do Philip B. Lee podcast, you see that? Search for that.
It's
One
okay.
word, one word.
One word.
You search this and you should find.
Okay, it's one word.
Did it work? It should take a second. It should not take very long.
I'm on a different laptop.
Doesn't matter. But anyways, that's how you get there. So, well, I think that's it. Thank you, everybody, for coming.
Thank you, Phil.
Thank
We
you.
have a session next month, and that'll be the one.
Phil, thank you for putting in all the work
Thank
that
you.
you've
Thank
done
you.
on
Have
this.
a-
And
Bye, everybody.
I am
Phil.
Richard Floyd, Phil. Thank
Phil
you.
Peter,
See you, Naman. Thank you, Phil.
I'll call you because you're going to the dim sum, right?
I'm going.
I'm jealous.
Call me. Call me, Emmett. Call me.
You can
Guys,
come, Mary.
Talk offline.